Hey everyone, it's Adarsh. And let's be real, who doesn't want to grow their money? Investing in the stock market is like getting your money to make more money, even while you sleep. But there's a right way to do it, and that's what we're diving into today. Whether you're just starting out or you've dabbled a bit and want to level up, this video is your roadmap to investing. We're breaking down everything, from the lingo to picking the right investments, so you can feel confident about putting your money to work. No more feeling lost or intimidated by the stock market. By the end of this video, you'll have a solid foundation to start building your own investment portfolio and working towards your financial goals. Let's get started.
Okay, before you even think about throwing money into the stock market, we need to lay down some groundwork. Investing without understanding the basics is like trying to navigate a maze blindfolded. You need to know where you're going and how to get there. It's like building a house. You don't start with the roof, right? You need to start with the foundation, the very base that will support everything else. You need a solid foundation. Without it, everything else will crumble. This foundation in investing is your knowledge and understanding of the market. First up, let's demystify some basics. Understanding these will make everything else much easier to grasp. When you invest in the stock market, you're essentially buying a tiny piece of a company, called a stock. This means you own a small part of that company. The stock market is where these stocks are bought and sold, kind of like a giant online marketplace. It's a place where buyers and sellers come together to trade shares. And the stock exchange is the specific platform where this trading happens, like the New York Stock Exchange or NASDAQ. Now let's talk vocabulary. Knowing the lingo is crucial. Dividends, that's your cut of the company's profits paid out to shareholders. It's a way for companies to share their success with you. Market capitalization. Think of it like measuring a company's overall worth. It's calculated by multiplying the stock price by the total number of shares. And then there's the bear and bull market. These terms describe the general trend of the market. A bear market is when prices are falling. Kinda scary, but it happens. It's a period of pessimism and declining prices. A bull market is when prices are rising. Everyone's happy. Everyone's making money. It's a time of optimism and increasing prices. But hold on, we're not done with the basics yet. There's more to learn before you can confidently invest. You need a game plan, an investment strategy. This is your roadmap to achieving your financial goals. There are a few main approaches. Each has its own set of principles and strategies. Value investing. That's all about finding those hidden gem companies that are undervalued by the market. You're looking for stocks that are priced lower than their true value. Growth investing. You're betting on companies with high growth potential. Think tech startups. These are companies expected to grow at an above-average rate compared to other companies. And then there's dividend investing, focusing on companies that pay out those sweet, sweet dividends. This strategy is great for generating a steady income. Remember, knowledge is power, especially when it comes to your money. The more you know, the better decisions you can make. Take the time to really understand these fundamentals before you jump in. Educate yourself, read books, attend seminars, and stay informed. Trust me, your future self will thank you for it. A well-informed investor is a successful investor. So start building that foundation today.
All right, now that you've got some basic knowledge under your belt, it's time to talk about you and your money goals. Understanding your financial objectives is the cornerstone of any successful investment strategy. What are you actually trying to achieve by investing in the stock market? Are you looking to grow your wealth over time, or are you aiming for a specific financial milestone? Are you saving up for a down payment on your dream house? That's a short-term goal, typically spanning a few years. Short-term goals require a different investment approach compared to long-term ones. Planning for retirement a few decades down the line? That's a long-term goal. Long-term goals allow you to take advantage of compound interest and ride out market fluctuations. Having clear objectives helps you figure out how much to invest and what kind of investments to choose. It also helps you stay focused and motivated, even when the market gets volatile. Next, let's talk risk tolerance. How much of your money are you comfortable potentially losing? This is a big one. Your risk tolerance will influence your investment choices and your overall strategy. Investing always comes with some level of risk, and understanding your risk tolerance will guide your investment decisions. It's important to balance risk and reward to align with your financial goals. And finally, let's get real about your budget. How much money can you realistically invest each month without putting yourself in a financial bind? Your budget should reflect your income, expenses, and savings goals. Creating a budget and sticking to it is crucial for successful investing. Remember, consistency is key. Regularly investing a set amount can help you build wealth over time and achieve your financial goals.
Now it's time to choose your weapon, your tool for conquering the stock market, your brokerage account. This is where you'll actually buy and sell stocks. But first, you've got to do your research. There are tons of brokerage firms out there, each with their own fees, features, and investment options. Don't just go with the first one you find. Think about what's important to you. Do you want a platform with tons of research and educational resources? Are you looking for low fees or a specific type of account? Speaking of account types, you've got options here too. A standard brokerage account is great for general investing, while retirement accounts like a 401k or IRA offer tax advantages for long-term savings. Once you've compared your options, it's time to open your account. This usually involves filling out an online application and providing some personal information. And just like that, you'll be ready to start investing. All right, you've got your account set up. Now it's time to build your investment portfolio. This is where the real journey begins, and it's crucial to approach it with a well-thought-out plan. Think of this as your investment dream team, a collection of assets carefully chosen to help you reach your financial goals. First up, diversification. This is the cornerstone of a robust portfolio. Don't put all your eggs in one basket. Diversification means spreading your investments to manage risk effectively. Instead, spread your money across different asset classes like stocks, bonds, and real estate. Each asset class has its own risk and return profile, balancing your portfolio. This helps reduce your overall risk. By diversifying, you protect yourself from the volatility of any single investment. Next, decide on your asset allocation. This is a strategic decision that reflects your risk tolerance and investment horizon. This is how you'll divide your money among different asset classes. A well-balanced allocation can enhance returns while minimizing risk. A more aggressive investor might have a higher percentage in stocks, aiming for higher returns but accepting more risk, while a more conservative investor might lean towards bonds, seeking stability and lower risk. Now for the fun part, choosing your investments. This is where you can tailor your portfolio to your interests and goals. You can buy individual stocks, which is like owning a tiny piece of specific companies. This can be exciting, but requires careful research. Owning stocks means you have a stake in the company's future, sharing in its successes and failures, or you can go with ETFs and mutual funds, which offer diversification within a single investment. These are like baskets of stocks that track a particular index or sector, providing broad exposure with less effort. Remember, building a solid investment portfolio takes time and research. It's a continuous learning process. Don't be afraid to start small and gradually add to your holdings as you learn and gain more confidence. Consistency and patience are key to long-term success.
Congratulations, you're officially an investor. But this is just the beginning. The stock market is constantly changing, and successful investing requires ongoing learning and adaptation. Make it a habit to stay informed about market trends, economic news, and industry developments. Read books, listen to podcasts, follow financial experts. There are countless ways to keep expanding your knowledge. Regularly review your portfolio and make sure it's still aligned with your financial goals and risk tolerance. As your life changes, so too should your investment strategy. And finally, remember that investing is a marathon, not a sprint. There will be ups and downs in the market. Don't let your emotions dictate your investment decisions. Stick to your plan, stay disciplined, and focus on the long term.
There you have it. A crash course in investing. Remember, the stock market can be intimidating at first, but with the right knowledge and approach, anyone can become a successful investor. The key is to start small, stay informed, and stay consistent. Don't get caught up in trying to time the market or chase the next hot stock. Focus on building a diversified portfolio that aligns with your financial goals and risk tolerance. And most importantly, don't wait to get started. The sooner you begin investing, the sooner your money can start working for you. So take what you've learned today, do your own research, and start building your financial future. You got this.